Silver did not just drop because traders got scared. It dropped because a lot of people confused a winning idea with a safe position. They thought they were holding a lifeboat, but many were really standing on a trap door. And when the floor opened, it happened so fast that right and wrong barely mattered anymore. That is why this silver story is much bigger than one metal, one crash, or one exchange. If you like videos that pull the curtain back before the crowd realizes there was a curtain at all, stay close to this channel, because the next few minutes may save you from an expensive kind of confidence. Silver's recent rise made believers feel brilliant. Its violent drop made some of those same people feel cheated. But the hardest part to accept is that both feelings can be real at the same time. A lot of people are telling this story like it has only two options. Either silver was unstoppable and evil forces crushed it, or the whole bullish case was nonsense from the beginning. Both of those explanations are too small for what actually happened. The truth is messier, quieter, and far more useful if you care about keeping your money, because markets do something cruel. They can reward your analysis and still punish your positioning. They can move in the direction you expected and still remove you from the game before the payoff arrives. That is the part beginners hate and veterans never forget. Silver has always had a special power over people. It feels like money, but it also feels like rebellion. It attracts investors, preppers, traders, industrial buyers, history lovers, and people who no longer trust the financial system. When one asset carries that many emotions, price moves stop being simple math. So when silver started running hard, it did more than go up. It woke up old hopes. People who had waited for years felt like the market was finally admitting they had been early, not wrong. Every shortage story, every delivery rumor, every chart breakout added fuel to that feeling. Then came the kind of moment that turns excitement into dangerous certainty. The price started moving so fast that restraint began to feel stupid. People stopped asking, "What am I holding?" and started asking, "How big can I make this bet?" That is usually when a trade becomes fragile, even if the long-term case is still strong. Because once too many people crowd into the same idea using borrowed power, the trade is no longer controlled by the idea alone. It becomes controlled by the plumbing around the idea. And market plumbing is boring right up until it empties your account. That is what most people missed. Think of leverage like renting a much larger position than your cash could normally buy. It feels efficient when prices move your way. But if the landlord suddenly demands a bigger security deposit in the middle of the storm, you may be forced out even if the house is still valuable. That is what margin hikes do in plain English. They do not ask whether your long-term thesis is smart. They ask whether you can post more money right now. If the answer is no, your position gets cut, your selling hits the market, and that drop pressures the next person using leverage. Then panic stops being emotional and becomes mechanical. If you want more breakdowns of the moments when markets stop behaving like stories and start behaving like machines, make this channel part of your regular watch, because those are the moments that separate survivors from spectators. What looks like a dramatic betrayal is often just a brutal chain reaction. The first forced seller hurts the second hurts the 10th. Then the headlines arrive late and tell the public a fairy tale. Some say it was pure manipulation. Others say the move proves the whole silver thesis was fake. But a crowded leverage trade does not need a movie villain to fall apart. That does not mean bad behavior never exists in financial markets. It does. Big players have been fined before, rules are not applied equally, and powerful institutions protect themselves first. But if you blame every silver move on secret hands, you stop learning the open mechanisms that can damage you in public view. One of those mechanisms is the difference between owning metal and owning a claim tied to metal. Those sound similar when markets are calm. They stop feeling similar when stress shows up. And silver investors ignore that difference at their own risk. On major futures exchanges, a lot of what people call silver is really a contract. It is a legal agreement linked to silver, not a bar in your hand. Some contracts do end in delivery, but most never get anywhere near that point. They are open, traded, offset, rolled, or settled long before a truck has to move anything. That matters because scary ratios get thrown around during every silver panic. You will hear giant numbers comparing paper claims to physical ounces as if every contract holder plans to show up tomorrow demanding bars. That sounds dramatic, but it mixes together very different things. And when you mix everything together, you get fear, not clarity. Here is a simpler way to think about it. Imagine one flight to New York. Around that flight, there are tickets, loyalty points, travel insurance policies, airline fuel hedges, stock options on the airline, and hotel reservations tied to the trip. Those are all connected to the same journey, but they are not all people standing at the gate asking for one seat. Silver works the same way more often than people want to admit. The market around the metal is much larger than the amount of metal immediately changing hands for delivery. That does not mean the stress is fake. It means you have to measure the right kind of stress. The useful questions are not the loudest questions. How much silver is readily available for delivery right now? How fast is that available stock shrinking or expanding? Are people paying extra for immediate access? And are institutions acting like near-term supply is tight? Those signals matter because they tell you when the physical side of the market is straining. Rising lease rates matter. Premiums in one region versus another matter. Large buyers bypassing the paper market and locking up supply directly matters a lot. If this kind of hidden signal hunting is your thing, subscribe in the way smart people subscribe, not because a channel asked, but because you'd hate to miss the next clue once you know where the clues actually live. Now here is where the story gets even more uncomfortable. A stressed exchange is not the same as a powerless exchange, and many silver bulls talk as if the system will politely wait to fail in front of them. It usually does the opposite. When the exchange feels disorder rising, it reaches for its toolbox. It can raise margins, tighten position rules, slow the game down, or make holding the trade much more expensive. That is not theory, that is design. Think about the referee in a chaotic game. If the crowd storms the field, the referee does not sit back and say, well, the players wanted this. The referee stops play. Financial exchanges do the same thing when they believe stability is at risk. And that is why betting your whole silver thesis on a dramatic exchange collapse can be dangerous. Not because stress is imaginary, not because shortages never happen, but because the people running the venue have every incentive to change conditions before they let the building burn down in front of them. This is where a lot of retail traders got trapped mentally. They were not just betting on silver to rise. They were betting on a very specific route to that rise, one where the system would break in a neat cinematic way that rewarded their exact position. Real markets almost never give people that kind of perfect ending. What likely happened instead was a convergence. A crowded long trade in one part of the world met aggressive selling pressure and rising costs in another. Local traders who thought they had room suddenly had none. The squeeze story did not disappear. It got ambushed by liquidity. And liquidity is one of the least respected forces in all of investing. People study narratives, mine supply, central bank behavior, and industrial demand. Then they ignore the simple question of who can stay solvent if the price moves violently before the thesis plays out. That single mistake has ruined more correct ideas than bad analysis ever did. Some trading firms learned that the hard way. Some retail traders learned it through margin calls. Some ETF holders learned it when the product they owned behaved nothing like the real-world conviction they thought they had bought. And many still do not understand that those are different lessons from the same event. Because silver is not one thing in practice. A bar in your possession is one experience. A standard ETF is another experience. A leveraged ETF is a completely different animal, built for short-term trading, not for surviving a long war of volatility. That difference sounds technical until price starts swinging like a hammer. Then it becomes painfully human. One investor sleeps badly but keeps the position. Another gets liquidated at the worst possible level and watches the market recover without them. If you're still with me, here's the question that matters. When the next big silver move comes, do you want to be emotionally correct or structurally prepared? That answer determines more than your opinion ever will. Because silver's deeper case did not vanish in the crash. If anything, the move exposed how tense the system already was. Silver is not just a fear trade, it is also a working metal in the modern world. It goes into electronics, solar systems, advanced manufacturing, defense applications, and the wiring behind a more power-hungry economy. That makes its demand story very different from the simple doomsday cartoon many people tell. At the same time, supply is not easy to turn on like a light switch. A lot of silver comes as a byproduct from mines focused on other metals. So even if silver demand rises sharply, producers cannot always respond by flooding the market with fresh supply. That creates a strange setup. Demand can tighten faster than production can adjust. Now add one more layer. Silver lives in two worlds at once. It behaves like money when trust is falling, and it behaves like an industrial material when growth sectors are expanding. That dual identity is powerful, but it also makes silver more emotionally unstable than many investors expect. When fear dominates, people want protection. When growth dominates, industry wants material. When both stories start competing at the same time, price can become wildly jumpy because different buyers want the same metal for different reasons. That is part of why silver can feel brilliant one month and unhinged the next. So instead of looking at silver through one lens, it helps to use three clocks. The first is the story clock. That is the public narrative, the headlines, the excitement, the fear, the social media certainty. It moves fastest and lies most often. The second is the liquidity clock. That is leverage, margin rules, funding pressure, forced selling, and the hidden stress inside paper positions. This clock moves slower than headlines, but faster than supply chains. And when it snaps, it can overpower the story clock instantly. The third is the physical clock. That is mine output, fabrication demand, industrial contracts, inventory drawdowns, regional premiums, and real-world availability. This clock is slower than the other two, but it is the one with the deepest authority. Over time, the physical clock tends to drag price back toward reality. Most people watch the first clock. Some professionals watch the second. Very few ordinary investors have the patience to anchor themselves to the third. But if your thesis is multi-year, that third clock is the one you cannot afford to ignore. Here is why that matters so much right now. The liquidity clock can knock silver down hard, even while the physical clock remains tight. That feels impossible if you think price always reflects truth in the moment. It feels normal if you understand that markets often overshoot because people, rules, and funding pressures get there first. Picture a grocery store during a storm warning. The shelves are actually getting emptier, but for one day, the store runs a deep discount to clear chaos at the checkout. The lower price does not mean food suddenly became abundant. It means the system around the food had a problem. That is how some of these silver drops work. A falling paper price can happen during real physical strain, not forever, but long enough to break weak hands. That is why the loudest traders often disappear before the patient investors ever get paid. If this changed how you see the chart, that's your signal to stay connected here, because the most valuable market lessons usually show up disguised as contradictions, and we spend a lot of time unpacking those contradictions on this channel. So where could silver go from here? There are a few paths, and none of them care about your emotions. That is why we have to separate excitement from probability. One path is the dramatic one everybody dreams about. A severe delivery event, public panic, and a vertical price spike that shocks the world. Could it happen? Yes. Is it the base case you should build your financial life around? Probably not. Another path is more realistic and far less cinematic. Physical tightness keeps building. The paper market gets managed aggressively, and price still grinds or surges higher over time without a total breakdown. That path frustrates thrill seekers because it rewards patience more than prophecy. But it may be the path that hurts the fewest prepared investors. There's also the slow path. Silver chops around, scares everyone repeatedly, and climbs in stages as industry keeps absorbing supply and confidence in easy money keeps fading. This path is emotionally exhausting because it offers no neat victory speech. It just keeps testing whether you really believed your own thesis. Then there is the ugly path. A recession or credit shock hits, everything liquid gets sold, and silver gets dragged lower with the rest of the mess before recovering later. That scenario punishes anyone who thought volatility was gone for good, but it can also create the kind of entry that only exists when people are too tired to act. Notice what these paths have in common. In almost all of them, the investor who is not over-leveraged has a major advantage. The person with patience, durable positioning, and some cash reserve has choices. The person with borrowed conviction has a deadline, and deadlines are deadly in volatile markets. Silver does not just test your beliefs, it tests your structure, your timing, your product choice, your risk limits, and your emotional honesty. It asks whether you wanted to be right or whether you wanted to stay solvent long enough to benefit from being right. That may sound harsh, but it is actually freeing, because once you understand that, you stop chasing magical scenarios. You stop needing the exchange to fail, the banks to confess, or the crowd to agree with you next week. You start building a position that can survive reality instead of a fantasy that depends on drama. And that is the deeper lesson hidden inside this whole silver episode. The biggest danger was not just volatility, it was confusion. Confusion between metal and contract, between thesis and tool, between eventual truth and immediate price. A lot of people can explain why silver matters. Fewer can explain how silver trades under pressure. And that gap between why it matters and how it behaves is exactly where money gets lost. The market punishes vagueness with terrifying efficiency. So if you believe silver still has a strong future, the smarter question is not how loud can this story get? It is, what form of exposure can survive the path between here and there? That question is less exciting. It is also the question adults ask. Last thought, and it may be the only one that sticks. In the next silver move, the winners may not be the people who shouted the hardest about shortages, corruption, or moonshot prices. They may simply be the ones who understood one plain fact before the crowd did. A real asset can be valuable for the right reason and still become deadly in the wrong wrapper. So watch the stories, but respect the plumbing. Watch the headlines, but study the rules. Watch the price, but ask what kind of position can survive the journey. Because in silver, the difference between wealth and wipeout is often not what you believed, but what you believed through. And when the next violent move arrives, remember this: the market does not only test your opinion of silver, it tests whether you chose substance over symbolism, structure over excitement, and reality over a promise written on paper. That is where the whole game changes.